Well, how's it going, friends and family? My name is Amos, and welcome to part 4, aka the No Dividends, No Problem edition in my best ETF series. By the way, this is the last video in this series. In part 1, we covered the growth ETFs for set it and forget it. In part 2, we did the safe and steady ETFs. And in part 3, we covered the retirement income, the high juicy dividend yield passive income payers in part 3. However, today's video is for the investor that wants to prioritize a hands-off, set it and forget it growth portfolio, but you don't want to deal with any dividends because you're allergic to dividends. You're kind of weird like that. I'm personally a dividend growth investor, if you don't get it by now, but I understand where some of you are coming from because maybe you don't want to pay taxes on your distributions. Maybe you really just want to be hands-off when it comes to your investments. So having said that, I did a lot of research and I landed upon this. What you see on your screen right now is the Roundhill S&P 500 No Dividend ETF known as XDIV. And it's an actively managed ETF by Roundhill. Let me show you some of their more popular ETFs because I think if you're familiar with Yield Max, you're probably also in the know when it comes to Roundhill. So they also manage MAGS, QDate, WPay. I feel like this one has a lot of buzz right now, XDate, etc. And when we think about the strategy of XDIV, it tries to mirror the performance of the S&P 500, which is the index that it's trying to emulate. But what makes XDIV really interesting is that it'll hold a specific S&P 500 ETF up until the ex-dividend date. And then they sell out of it and rotate and switch into another S&P 500 ETF, such as like VU or SPY, or in this case right now, IVV, which is the iShares Core S&P 500 ETF. They're all the exact same thing essentially. So they juggle funds in and out around the ex-dividend date. And just in case I lost you, I mean, take a look at IVV, right? They have a dividend yield of 1.1%. So you might be like, wait, hold on. So why don't I get the dividends from XDIV? Because take a look at this. If I jump on over to the dividends tab, the ex-dividend date for IVV is September the 16th of 2025. And then the payout was September the 19th, right? The different S&P 500 ETF funds, they don't have the exact same ex-dividend date. So what they do is they just rotate every quarter so that XDIV gets the performance before the dividend payout date. So IVV, September the 16th. If we go to the Vanguard variety and version of the S&P 500 ETF, it's September 29th. And then if we do it again with SPY, that one is September 19th. So it's an actively managed ETF. And what makes this really interesting is that here in the US, when it comes to ETFs, when they sell their assets, like their underlying stocks or whatever it is that's in their holdings in the portfolio tab, they don't have to pass on the capital gains as a taxable event to you as the investor. And because this ETF does not receive dividends, it also does not pass on those non-existent distributions. But something that I do want to call out is it was really freaking hard to find an ETF that mirrors the performance of the S&P 500, otherwise referred to as the benchmark, the standard, aka the market that we're all trying to beat or compare our performance to, because almost every single one of them pay a freaking dividend. But this one, as the name suggests, it does not pay a dividend. However, it is worth mentioning that it's only been around for, here, if I click on year to date, or actually max timeline history, XDIV became publicly listed on July the 10th of 2025. So if you do the math, they've only been around for a little more than 3 months. I guess now here in Japan it's November the 1st, so almost 4 months. That's it. However, I think the next question is, well, are they performing in line with the S&P 500? I love that question. Look at you with your receding hairline being so smart. Well, let's take a look at it. So as we just learned, XDIV, they've only been around for like 3.5 months. So if we zoom back to 3 months, so XDIV, 8.5% in the green as the total return in the past 90 days, with the S&P 500 ETF known as VU, 8.2%. So friends and family, it does in fact look like XDiv gives you a similar performance and ROI, return on investment, to VU. But what about, I don't know, let's do SPY. If we compare this bad boy to SPY, and we also do 3 months. I'm on a website called financecharts.com. This is free, by the way. If we do 3 months, then the XDiv is 8.5% in the green, whereas SPY is 8.2%. So if you want an S&P 500 ETF that does not pay a dividend, XDiv, for the time being, seems plausible and it seems like it's coherent. What I don't like is that it really doesn't have a long history. Because when we think about SPY, if I zoom out 5 years, they've got that timeline. We know how they behave. I mean, it follows the S&P 500, but if we do 10 years, they've got the timeline. 15 years, they've got the timeline. If we do 20 years, they've got the history to back it up. With XDiv, it works right now, but who is to say it's going to work in the future? I mean, it seems pretty simple, right? They just buy, sell, and rotate among the different S&P 500 ETFs around the ex-dividend date. So I feel like it's not a bad strategy. Even I could do it. That seems pretty easy. But to do that manually is kind of annoying. So why not just have XDiv do the dirty work, the leg work, the heavy lifting? And all things considered, when I think about the expense ratio, the fees that are taken out of your performance to pay the Roundhill fund managers, I mean, a 0.08%, it's not too bad. I mean, let's compare it to the BlackRock iShares variety, 0.03%. And if we do SPY, I feel like that one's going to be low as well. No! So XDiv takes less as their ETF expense fee. And just for fun, let's just do VU. VU is 0.03%. But I'll tell you what, if you're not a fan of Roundhill or their strategy with XDiv, then I've got you. Here's what I'm thinking. Now, this next combination, it's not going to be an ETF, but they might as well be, because the way that they act, behave, and operate, they're pretty much an ETF, okay? And that's going to be the Berkshire Hathaway Class B shares, BRK.B. And Berkshire Hathaway might sound familiar to you because it's the company associated with Warren Buffett, because he's the leader of the company, but he is stepping down in a matter of weeks, and they're going to transition to one of his top lieutenants. So Berkshire Hathaway, it's a conglomerate that owns and has their hands in almost every line of business here in the US. Primarily, they're known for their insurance and their energy side of the house, like Berkshire Hathaway Energy, Geico Car Insurance, but they also own BNSF, which is a pretty big railroad network. I would argue it's a competitor to Norfolk Southern and Union Pacific, but they're also the parent company of one of the best running shoe brands. I'm not sponsored by them, but I can wholeheartedly say that I really like Brooks running shoes, way better than Hoka. I would argue Brooks is right up there with New Balance and maybe Saucony. They also own the undershirts and boxers and underwear company Fruit of the Loom. They also are the parent company of Dairy Queen, the fast food restaurant chain, Business Wire, the online magazine, See's Candies, and they're also the majority owner of a whole bunch of different companies that might resonate with you, such as Apple. They own 5.6% of the shares outstanding, about 20% of American Express. So as you can see, they're pretty diversified across the board. And if I pull up Berkshire Hathaway and we take a look at their financials, dude, I'm about to blow your mind. So Berkshire Hathaway, they do have two different shares. They have the Class A, but take a look at their price point, right? $715,000 per share, and that's because they've never done a stock split. The trading multiple is a 16.3, and that's why I think it's more sensible and it makes more sense to be looking at their Class B shares. BRK.B trades for $477 a share. Jump on over to their financials, and we click on the balance sheet. Just take a look at how much cash and cash equivalents that they have on hand. $344 billion. Friends and family, that's funny money. That's a lot. And of that, $100 billion is in cash. And the other $243 billion, it's in a high-yield savings account, a money market fund, a certificate of deposit, a CD, whatever is highly liquid, but it all adds up to $344 billion of cash on hand. Dude, that's actually very wild. So Berkshire Hathaway, a company that's prominent in the supply chain space, but also serving up burgers and ice cream, how are their fundamentals? If we take a look at their revenue, I mean, they're generating $370 billion in the past 12 months. Dude, that's absolutely ridiculous. Because 10 years ago in 2015, it was $201 billion. So this is a company that prints cash. And to verify that, let's take a look at their free cash flow. Now, mind you, this is a company that has a lot of CapEx because they have a lot of overhead costs, because they also sell machinery, equipment, and items, and they're not a software company, okay? The insurance arm of the business, very asset light, but because it's a conglomerate, I don't know how good their free cash flow might be, but taking a look at it, $8.2 billion, not bad. But what is bad is the trend, negative 74% year over year. It's shrinking by a lot. It's probably because they're using a lot of their cash on hand to do something, to do buybacks, to reinvest back into the business, to expand their production capacity. But it is kind of alarming because back in 2023, they did have $29.7 billion of free cash flow. But to see $8.2 billion, it's not going in the right trend, but it is still flush in cash. If that trend continues and it stays consistent and goes down to like $4 billion of free cash flow in the next fiscal year, that would be a red flag in my opinion. So Berkshire Hathaway, they do not pay a dividend, and that's why there's not even an option to take a look at their dividend. But I'll give you one more. This is also not an ETF, but they might as well be. Because just like Berkshire Hathaway, they basically have their hands in almost every single sector and space of business here in the US. And speaking of space, they also operate satellites that go into the outer galaxy, as they say. By the way, I'm old enough to realize that Pluto used to be a planet. Now there's people out here that dismiss it and say it's just a big moon. That's pretty crazy. But anyways, that company is Amazon. I literally just made an updated deep dive and analysis video talking about them. But as you can see on your screen right now, Amazon is a behemoth. They're a conglomerate. If you only associate them with the e-commerce platform where you buy the stuff that you shove up your booty hole for like $35 because that's how you get free shipping, then you're so wrong. Because as you can see, dude, every single one of these brands are owned and operated by Amazon, except if it says like 15% ownership. So Amazon, they're the parent company of the MGM production studio, Twitch live streaming, Audible, audiobooks, IMDb, Hollywood, Resumes, Zappos where you buy shoes. But if we scroll down, you can also see that Amazon operates in the healthcare space, and they're also offering virtual doctor services alongside with their Amazon pharmacy. They also operate in an organic grocery store chain, Whole Foods. They also operate AWS, which is one of the biggest cloud networks in the world, arguably best in class. And all of these different gadgets and items, such as like Alexa, Ring, you know, when someone drops off a package from UPS or Amazon, you can spy on them. There's a doorbell Ring. They also have ZooX, robo-taxi services in Las Vegas. They do a little bit of everything. If you want to hear the full deep dive, you got to go watch the video that I made about them. So I would argue, even though Amazon is not officially registered as an ETF, because they're so diversified in all of their businesses and endeavors, they might as well be an ETF. They're kind of like the modernized version of Berkshire Hathaway, if that makes sense. Like Amazon skews heavy towards the tech and software space, whereas Berkshire Hathaway is more of the CapEx heavy industries that were successful 40, 50 years ago, and they still find a way to be successful in 2025 and going into 2026. And to be honest with you, it's really difficult and almost a challenge to pick the better one between the two, right? Berkshire Hathaway versus Amazon. So why not both? Okay, so if we take a look at the performance from January of 2016 to September of 2025, and our portfolio is broken down very even across the board, 50% allocated towards Berkshire Hathaway and the other half for Amazon, and we have $10,000 invested into them, and we're going to benchmark it against the S&P 500. Well, the results, friends and family, pretty cool. If I scroll on down, I'm on a website called portfoliovisualizer.com. This is also free. Let me just zoom in so you don't have to pull out your reading glasses, you old fart. So our portfolio, the no dividend growth our self-created ETF with Amazon, Berkshire Hathaway, that $10,000 in a span of about, 9 years, it would have turned into $57,849. The CAGR, the compound annual growth rate, how much your money would have grown on an annualized level, 19.7%. Now, if we compare it to the benchmark SPY, the S&P 500 ETF, the $10,000 would have turned into $38,400 in the exact same timeline, which I still think is pretty respectable with a capital R, a 14.8% ROI year over year. That's pretty good, right? But this is where things get a little hairy and a little weird, because during the best year, the no dividend growth ETF portfolio that we made, you would have seen an ROI of 48% in that single year. On the other hand, with the S&P 500, 31.2%, which is still really good. But during the downside, the no dividend growth portfolio would have also seen bigger and deeper red. Negative 28% versus the S&P 500's negative 24%. If you want to take a look at it visually, let me just scroll down here so it's a little prettier. Oh wait, let me zoom out. It looks like the color code blue is our portfolio and the teal is the S&P 500. As you can see, when the times are good, our portfolio would have outperformed the S&P 500 by a significant margin. And when the times are bad, they also dip a little bit further. I think there's a bar chart here that will show that depicted. Yeah, so when the times were bad in 2022, the no dividend growth ETF portfolio, negative 23%, S&P 500, negative 18%. And if we take a look at the share price appreciation, the performance, we pull up Amazon and we compare it to BerkB to see who actually did most of the heavy lifting between the two. Past 1 year, Amazon 31% into the green, Berkshire Hathaway 5.9%. We zoom out and do 5 years, 62% for Amazon, and Berkshire Hathaway was 133%. So very recent times, Amazon is crushing it, Berkshire Hathaway kind of lagging behind. But holistically, past 5 years, it's the other way around. If we do 10 years, Amazon 677%, Berkshire Hathaway 245%. So it looks like they take turns overperforming the other or outperforming the other. And in 15 years, Amazon is just shy of 3,000% total return, Berkshire Hathaway 500%. But I think they balance each other out. And that's why I think an Amazon and Berkshire Hathaway portfolio together that do not pay a dividend is a pretty sound set it and forget it portfolio. And before I go any further, I wanted to address this comment left by Amitas Lynn 9 hours ago. I love your videos. Would love to see you do more videos per week. Now, believe it or not, I used to upload every single day of the week leading up to the middle of October, because right now I'm rolling into my 3rd week as being a first-time dad. And they actually call it the newborn trenches for a good reason. I learned quickly why it's called the newborn trenches. You ain't gonna sleep. You're gonna be sleep deprived. You're gonna be cranky, hungry, irritated, and your mind is just a mess. Up here, it's just discombobulated. It's a hot mess right now. My ability to think fast, to think critically, and to be clever and witty, I realize I'm just not myself these days, and that's because my entire routine has been wrecked in order to keep the little potato alive. She literally cries if she's hungry, if she's cold, if she's bored, if she needs to be held, and this constant attention and care to the little kimbap, the sushi roll, the burrito, it's not only during the daytime. It also happens in the nighttime. To put it into perspective, if for those of you who are not in parenthood or never want to be, if you've ever had a dog or a pet, like training your dog not to pee all over the carpet, training them to do tricks and to be gentle when you walk them on a leash, I would argue the difficulty of raising a puppy into a dog that's respectable and is cute and listens to commands, like a 3.5 out of 10. 10 being really difficult, 1 being so easy. Okay, raising a dog to me, 3.5. The newborn trenches that I'm in right now, my goodness gracious, we got to pull that lever up. I would argue it's like a 6.5 to maybe a 7, depending on if I'm running on 1 hour of sleep, I'm running on empty, I'm hungry, and I'm like, oh my gosh, brother. It's so much more difficult. It's twice as hard as raising a dog. All that to say, there are those of you that are about twice my age. You've already raised your kids, they're full-on adults, and now you're a grandfather or a grandmother, and you keep telling me to cherish this time, to don't take it for granted, and to be present. And so I'm trying to do that, trying to be positive, and eventually I'm hoping to get back up to my ops tempo and frequency of uploads. But as of right now, I'm trying to do the best that I can. So I'm uploading whenever I have the free time. So hopefully that answers this comment. I used to upload a lot more. I want to. Believe me when I say that, it's just I really can't. My bandwidth is just maxed out. Obviously, if we were to throw down some CapEx and we duplicate me and there's 2 Amoses running around, maybe we could. But that's one of my biggest struggles. The fact that there's only 24 hours in a day, I feel like I could accomplish and achieve a lot more if there was like maybe even 25 or 28 hours in a day. But the constraints, I'm trying to do the best that I can with what I'm working with. Now, to close out the video, when I think about the combination of XDiv versus Amazon and Berkshire Hathaway, personally, I know this is going to be very unpopular, I would rather go with the second combination. If I had to make an educational guess, I think the second combination is going to outperform XDiv and the S&P 500 in the next 10 to 30 years. You can quote me on that. I'm not a genie in a bottle, but just for fun and entertainment purposes, I genuinely think that Amazon and Berkshire Hathaway are going to outperform the S&P 500. Now, I will rebuttal that by saying this. Maybe Berkshire Hathaway will mirror the performance of the S&P 500, but Amazon, for sure, maybe double or even triple the performance. And at this point in the video, I already know most of you have clicked away, so I'm going to give you a little insight and an update into how life is going. So the QRF, the reinforcement, has arrived. And what I mean by that is the mother-in-law has finally arrived in Japan, and she's been helping out for the past few days, which is why I've been able to upload more frequently, and she's going to be here for the next 2 weeks as well. So I feel pretty thankful, because up until that point, dude, I was struggling. Because believe it or not, I hold this idea in my head where, as a husband, you're not just the leader of your household, you also have to possess the ability to flex and know when to be the servant and when you have to serve your partner, your wife, right? Just because you're the head of the household, it doesn't give you permission to get out of all of the dirty work. And so consequently, because I'm a man of my word, I've been breaking my back doing everything around the house leading up to the reinforcement arriving. And that means cleaning, cooking, dishes, diapers. I'm not gonna lie to you, dude, I was exhausted and I'm still pretty tired. But now that the mother-in-law is here, she's been helping out with the cooking and everything, so super blessed. But I will say this, dude, they've been arguing so much. I'm whispering because I don't want them to hear, but like the wife and the mother-in-law, just non-stop disputes, bickering, and arguing. And the thing is, when you think about it, when you give birth to a baby, especially as like a first-time mom, your body, your mind, and your soul, it goes through a complete mental and hormonal transformation, right? And that happens because biologically it's wiring you in order to be able to breastfeed or to put on a different hat so that you can raise and keep this little thing alive. And because the hormones are going through the roof, it's kind of common to see the new mom be on edge, to be irritable, to be quickly annoyed, to be very emotional, to break out in crying, like just out of the blue, the emotions to go from 0 to 100. So personally understanding that, because my undergrad degree was in psychology, okay? Understanding that, I've been giving the wife a lot of grace. So knowing that she's going through this transformation, I've been doing the best that I can to serve her, right? Because I just want to take away all the stress and burdens that she might have on her plate to just focus on resting, recovering from the 2 surgeries that she had, and to keeping the little one alive with the milk. But I think the mother-in-law, I know she has good intentions, okay? but she has been stepping on the wife's toes a lot, and so they've been arguing back and forth. And I will say that the tensions in the house is pretty high. I feel like at any moment everyone's walking on eggshells. I'm over here just trying to be nice, kind, be gentle, make videos whenever I can, and then I see the two of them. I try to keep them separated as much as possible if I feel like an argument is coming, but yeah, so that's what's happening in my life right now. But having said that, I still feel very thankful that the reinforcement is here and is helping us. Yeah, it's pretty crazy. Newborn trenches is very real. If you are a father or a grandfather, you probably know exactly what I'm talking about. If you're a young one, or if you're someone that's not married, dude, it's crazy. But anyways, I gotta get out of here because I gotta help out with the baby. I'm doing the laundry right now, so I love you guys. Stay safe. Good luck in the stock market, and I will talk to you eventually. Peace.